Shaktikanta, the governor at RBI. He's currently speaking at CII's annual session. Let's listen in.
2024. The economic slowdown is, however, concentrated in advanced economies, with Asia-Pacific region expected to contribute about 70% of global growth in 2023. And according to the same estimates, India will contribute about 15% to global growth in the current year. Financial markets remain volatile as uncertainty over future monetary policy path is keeping market sentiments on the edge. New Zealand has earlier today increased its rates by 25 basis points. Food and energy insecurity and risks of debt distress pose downside risks to outlook for emerging market and developing economies, that is EMDEs. According to IMF, 39 low-income developing countries are in debt distress or at the risk of debt distress. On the upside, global growth is being supported by the easing of supply chain disruptions, gradual normalization of energy and food markets, easing commodity prices, and reopening of the Chinese economy. Global inflationary pressures are also showing signs of abatement, although they remain well above the target in most of the countries. Central banks across the world have continued to tighten monetary policy, though at a much slower pace relative to the aggressive 75 basis points rate hikes which we witnessed in 2022, while some central banks have even taken a pause in their recent meetings. We have a case of Canada which took a pause and then again went for an increase. So therefore, global monetary policy is still settling down because the inflationary conditions are fast evolving. And all central banks are watching it with what I call an Arjuna's eye, or what others call a hawk's eye. As central banks raise interest rates rapidly to contain inflation, fault lines emerged in banks and non-bank financial intermediaries. The resilience of the global financial system has been severely tested in the recent times, following the banking sector turmoil in the United States and in Switzerland. Naturally, it resulted in financial stability concerns, not only in those countries, but all around. Quite naturally, the outlook has been adversely impacted, particularly in the advanced economies. The proximate cause of this banking turmoil in the United States and Switzerland in March 2023 is a confluence of rising interest rates, unrealized losses in debt securities portfolio, and other idiosyncratic risks. Coexistence of high inflation and banking stress is complicating the responses of central banks as they face a trade-off between the risk of either straining financial markets or having to tolerate longer periods of high inflation. Amidst these global uncertainties, the Indian banking system remains stable and resilient, with strong capital and liquidity positions, improving asset quality, better provisioning coverage, and improved profitability. Let me now turn to the domestic growth scenario. Sanjeev has already touched upon it, as I said. For the current year, for the year that has just ended, that is 22-23, the estimates are that it will be 7%. But there is a possibility that it could be even more. The data will come at the end of this month. According to all the recent trends, it will not be a surprise if the GDP growth of last year comes slightly above 7%. But let's stick to 7% for the time being. And the trends, the fourth quarter trends in particular, it initially appeared in the third quarter that there was a pent-up demand which was supporting economic activity. But all the economic indicators in the Q4 of last financial year they saw that economic activity sustained momentum, and in fact, all the fast move, high frequency indicators, about 70 of them which we monitor in the Reserve Bank of India, almost in all of these high frequency indicators, the momentum was maintained in Q4. So therefore, I will not be surprised, we should not be surprised if the growth is slightly more than 7%. For 23-24, we have given a figure of 6.5%. And we have said that, with lot of, we have done our internal analysis. Of course, the IMF and other international institutions have given lower projections. For instance, the IMF projects it at 5.9%. But we derive confidence at this point of time from the fact that agriculture has done well, and we are assuming a normal monsoon. Services sector continues to perform very well. In fact, as you all know, although merchandise exports slowed down, moderated last year and have moderated, it is the services exports which have really gained further momentum. So agriculture has done well. Services sector on the whole is doing well. The capex and the infra spending by the government has also picked up with, again, large provisions in the budget for capital expenditure by the government. There is evidence of revival of private investment also. We notice it in certain sectors, particularly steel and cement. Your members of CII will know better. Capacity utilization in the manufacturing sector, according to RBI's latest survey, which we have published, is around 75%. But I am told that the CII's survey shows that capacity utilization in manufacturing sector is even higher. I don't know whether they have shared the number with you, so I'm not mentioning it, but in our interaction last week in Mumbai, I was told that, I have the number, and it is clearly much more than 75%. So capacity utilization in the manufacturing sector continues to be robust. Credit offtake in banks also is remaining quite resilient. It's about 15.5% credit growth according to the latest data. Over the last 1 year, we see credit offtake. The banking sector credit, I'm talking about bank credit, the growth is about 15.5 to 16%. The latest number I have is 15.5%. So therefore, these are the, these are the upsides to domestic growth, and that gives us the confidence that, India should be able to record a growth close to 6.5%. However, there are downside risks which are commonly, which is known to all of us. Geopolitical uncertainties, any surprises on the geopolitical front, and the drag from merchandise exports because world trade seems to be contracting. So these are the downside risks. And of course, on the agricultural front, there is this forecast of a El Nino, and we have to see whether it actually happens or how, if it happens, how intense it is. And there is talk by the IMD about the Indian Ocean dipole. I am not an expert, but the IMD says that there is evidence of positive Indian Ocean dipole, which to some extent should be able to neutralize the impact of El Nino. But let us leave that to weather experts. But this is an uncertainty which only time will tell to what extent it affects our economy. On top of this, all these factors which I mentioned, we have macroeconomic stability. Now, on the back of macroeconomic stability and the robust financial sector stability that we have, I think there is a platform for supporting domestic growth. Macroeconomic stability in the sense that inflation has moderated. The last print, is 4.7. Perhaps the next print could be lower. GDP growth, I have just mentioned, that is sustained. Current account deficit, which was earlier feared that it will touch 4%, 3.5%, we have given out the numbers. They look very much, and in the last year, it was eminently manageable, as I have said. We were helped by the fact that we are now witnessing record, remittances from abroad. The fiscal deficit of the government is also on a consolidation path. So on the back of macroeconomic stability and a robust financial sector, I will touch upon the financial sector a little later, but on the financial sector, particularly our banking sector today, the percentage of non-performing assets, according to the last December 2022 number we gave, the GNPA, that is gross non-performing assets of the banking sector at the systemic level, was 4.4%. We have the unaudited figures for the period ending March 23. They are even lower, but I would not like to mention the number because they are unaudited, and we would rather wait for the audited figures to come in. So the non-performing asset, which was a huge challenge for the Indian banking sector, has come down, has been moderated, and it is showing very good signs of its resilience. And on top of that, we have the advantage of demography, which again is a huge opportunity for India, and it's something, I think, which will eventually add to our potential output, or what some people prefer to call it as India's, growth potential. But let us call it potential output. So therefore, that's a thing which will play out in the medium to long term. There is one aspect which I must mention in a forum like this. It is with regard to access to technology and investment in technology. We are living in a highly fragmented world. Access to technology, availability of technology in a seamless manner has become a challenge. In this matter, the world is no more flat. Technology has become difficult to access. There are barriers, there are restrictions to get technology, and it's not flowing freely across boundaries. So therefore, while, I think it's for the industry also, apart from, the various other authorities, I think it's for the industry to play a primary role and to have access, to work out access to that technology. And what's even more important, I think as a country, we need to invest more in technology. Because the future belongs to technology, and unless we have technology, we will not be able to sustain our progress. But I am quite optimistic that this is an area where the public and the private authorities, the public and the private sector associations like the CII and the authorities in the government will be able to work together, and this challenge will be converted into an opportunity. But domestic investment in technology has to grow, and private sector has a big role in it. India demonstrated that in the context of COVID, when the vaccines were produced within the country, and a population of 1.4 billion was vaccinated in India, perhaps the highest vaccination that was done world over. And I think we have the capacity, we have the potential, but this is something which I would, particularly in a forum through the CII, I would like to appeal to the members of CII to focus on this aspect, because this is something which India needs to sustain its growth. The third aspect I wish to talk about is with regard to inflation. Now, inflation has moderated, but there is no room for complacency. Let me just touch upon our, the inflation path that we went through, the challenges that we went through over the last 1 year. In February last year, the outlook was very benign. We assumed that inflation will come out. Inflation will sort of moderate. But then we had the big surprise from the Ukraine war. Nobody expected the Ukraine war to sort of really happen, and to sort of with such intensity. And naturally, it had impact on prices of food grains, on edible oil, on cereals, on across the board. The commodity prices shot up. The crude oil, which is again a primary, India being a huge importer of crude, all prices went up, and naturally India was impacted. Now, when the war came as a surprise, naturally, as a central bank, we cannot say that we will not give any surprises. I mean, we had to also, therefore, do a surprise meeting last year. Many of you, that time it looked, in fact, we faced quite a bit of criticism. But what the market missed out at that stage is that in April itself, we had given some early signals of our impending action. We had changed our priority to inflation over growth. And we had given some indications saying that the Reserve Bank is monitoring the situation closely and will not hesitate to act if the situation so warrants. So we took that surprise, we did that surprise meeting. One point which I want to mention here, nobody likes to give surprises, but when sometimes the situation itself gives you surprises and overtakes you, a situation like when the war happens, which was not expected by anyone, naturally, I mean, things are, different. So therefore, we had to have that surprise meeting of the MPC. I'm not trying to be defensive about it, because subsequent developments have proved that the decision of the Monetary Policy Committee to meet, to hold a surprise meeting and to start the cycle of rate increase was the right decision. And I think that has been now accepted and recognized all around. Again, last MPC, we gave you a positive surprise by taking a pause. I think the whole market was expecting that the Reserve Bank perhaps will take the Reserve Bank will perhaps increase by 25 basis points. But we gave a positive surprise because our assessment was that we have done 250 basis points rate increase. Let's now allow that impact to play out. Increase in rates, monetary policy acts with a time lag. And you have to allow that time for the monetary policy to play out and to transmit. We monitor the monetary policy transmission both in the credit side as well as both in the interest rate side so far as credit is concerned, the market interest rates are concerned, the overnight rates of money markets, so far as that is concerned. We also monitor the transmission in the liability side, namely in the deposit side. So therefore, the situation is extremely fluid, the situation is highly dynamic, and I would just like to say that the war on inflation is not over. We have to remain alert. There is no cause for complacency. Especially we'll have to see how the El Nino factor, what has been anticipated, the El Nino, how it plays out. The third aspect which I would like to mention is with regard to I think that is the fourth aspect which I would like to mention, is with regard to the policy approach of the Reserve Bank. Now, our endeavor, especially over the last 3 to 4 years, when we have been confronted, like the rest of the world, we have been confronted with huge uncertainties. We have been confronted with black swan events, one after the other. The COVID, followed by the war, followed by the synchronized monetary policy tightening, the fragmentation of global trade, the fragmentation of supply chain, and host of other challenges have, the sudden increase of commodity prices. We have really, I think all central banks, all authorities, and business in particular also, we have all gone through fire. And in times like this, it's very heartening to note that the Indian business has responded with resilience. The Indian business, industry and business on the whole has utilized this opportunity, utilized this challenge to improve, to strengthen its inherent resilience. When we undertook many liquidity infusion measures, we saw a clear evidence of companies, big and small, deleveraging themselves, using the liquidity available in the market, using the benign liquidity conditions. Corporates deleveraged themselves and repaid their reduced their high-cost borrowings. So as a result, when the pandemic ended, I think most of the corporates, or should I say many of the corporates, had balance sheets which were which were deleveraged compared to where they started before the pandemic. So far as the Reserve Bank is concerned, our approach and our endeavor has always been to be prudent, proactive, and act in time. These have been the guiding principles. Prudent, it's our endeavor to be prudent, proactive, and to act in time. While remaining always alert, it has been our endeavor to sort of respond to the situation and also anticipate emerging situations and then respond to that. I would not like to elaborate on that at length, but just I wish to touch upon a few points. For example, when the COVID started on 27th of March 2020, we again had a surprise meeting of the Monetary Policy Committee, and we announced a host of measures. We reduced the interest rates by